All right, well, let's get into your high conviction ideas in the energy sector. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, the first stock is Canadian or CES Energy Solutions. This is like a service company. Why do you like it?
Yeah, so a theme in our portfolios is if the commodities just stay right here, which businesses are mispriced, okay? And CES fits that bill. And when you look at where did a capital light service company like CES, their production chemicals, alongside drilling fluids and stuff like that. Companies like CES used to trade at 13 times EBITDA and stuff like that through the last run, right? Because it was such a good business. And so when you look at where CES was a year or two ago, it was at 4.5, 5 times. Today, the business is 5.5, 6 times. But it's important to pay attention to the subtleties too, right? Like you mentioned, it's a service company, but they're grabbing more US market share. They have a tailwind of industry across their back of longer laterals being drilled, more frac-intensive wells being drilled. The US rig count's down oil rig count's down over 10% year over year. CES just put out their Q3 numbers and they just put an inline print on EBITDA from where they were last year to this year, despite the headwinds of the drilling count going way much lower, right? And so these guys have done a really good job. They're a capital light service business. Today it trades at 5.5, 6 times EBITDA. Like these guys are going to keep grabbing revenue market share. They just won a big contract award. The stock was up 15% for us on Friday. It's a top 5 holding across our funds. If you start putting 8 times multiple on the 2027 forecast, it's a $17 stock. And so these are things that if oil and commodities just stay right here, I think it's going to go to that 8 times multiple. And what happens if the commodities go higher, right? It's going to have even more upside. So we don't need higher oil prices to make money in CES in our view. We think that can naturally just happen for where you're valuing the business today.
The market share story is interesting because like 5 years ago, it was like 13% US share of the drilling, and now it's like a quarter of it. Yeah. How high does that go, do you think?
Well, if you recall, like Champion X just went away, right? And so Champion X just got bought out. Like we think these guys are going to grab more market share from guys like that. When you look at this contract award, they kind of hinted to everyone that like we won this offshore contract award. But then when you delve into the details, you can't really work for some of these big super majors unless you're the full gamut stop guy. So all of a sudden you get the offshore work and maybe you get a little more Permian work at the same time. This is all tailwinds, right? This is all going in the right direction. So we'd expect that market share number goes higher over time.
Your next 2 picks have, and by the way, normally we do 3, but you really bonused us out. We're going to get a bunch of picks here. They have a theme and they're Clearwater oil companies. And you mentioned that you like this play. It's a heavy oil, a play in kind of west central Alberta, like 300 kilometers north of Edmonton. So there's 2 companies that you're talking about that are kind of these Clearwater plays. That's Tamarack and Headwater. Talk to me first about the play. You know, what's exciting about Clearwater, and then the exposure you're getting with Tamarack and Headwater.
Yeah, so this is the best oil play I've ever seen in my career. And that's where when you're just looking at this play and how it's kind of matured through time, they're drilling multi-leg wells. They're not fracking the wells. They're just drilling multi-leg wells. This is not service intensive. It's easier to drill. The spud to on-stream times happen really quick. But the big intriguing part of the play was just the declines don't happen like shale where it goes down really, really quick. So you drill your well, you get your money back from the cost of drilling that well in 7-8 months. And then you get that money back again 3 or 5, 6, 7, 8 months later. And then you get it back again. And then you get it back. You get multiple payouts on the well. Versus when you drill a shale well, you might get that money back pretty quick in 12 months. and then you never get second payout in some of these plays. And so the play was very intriguing, but then what's also transpired in the last 12 months is they started injecting a bunch of water back into the formation. And what that is going to do is take the oil recovery factors from 5 or 7% to 20 to 30%. So now not only are you getting those initial payouts, you're getting even more payouts because you're bringing the decline rates down. You're lowering the sustaining capital. When you lower the sustaining capital, you got more money for dividends and buybacks and more water floods and more wells. Like, this is all massive tailwinds for anyone with exposure in this play.
So let's talk about the difference between Tamarack and Headwater, because, you know, when I talk to people about these stocks, these seem like companies with vastly different health. You know, people love Tamarack and they're maybe a little bit concerned about maybe payouts at Headwater, debt, whether they have room for buybacks. Is there a major difference in the financial health of these companies? And do you see consolidation?
Yeah, I mean, that's a good question. And to kind of just set it straight, there's been no capital in our space the last 2-3 years. So it's all these hedge funds. Are you in the Tamarack camp or the Headwater camp? Like, which camp are you in? It's like, I am both.
Yeah.
I am both. They're all exposed to the right plays. So, and that's quietly been what's happening. Tamarack's leading on the year, then Headwater plays catch up the last month or so. We like both of these companies. Tamarack did a rockstar deal. Steve Bytel's on buying Delta Stream. This is a really good quality asset. It set this company up with inventory for the next 10, 15, 20 years. Headwater's been more finding plays, but then when you look at what these guys have found, they just found their Pelican play. And the Pelican play, like, they drilled a well there. It's been doing 500 barrels a day. It came on. You're like, oh my God, this payout's going to be 3-4 months. 8 months later, it's still doing 500 barrels a day. Like, they have a prize there. They're going to do polymer flood. They're going to inject polymer into this reservoir, and you're going to get so much cash and free cash out of this play over the next how many years. And so when we look at both of these together, we think you should own them both. We think that both of these companies have various attributes of just getting multiple payouts over time. And to your point, I don't know how the consolidation is going to ultimately play out. But when I look at where you're valuing these Clearwater businesses relative to their peers, I think they should be valued way higher. Quit focusing on the multiple. Start focusing on how much free cash are these businesses going to spin off in the next 5 years. Headwater's 60% of their enterprise value that you'll generate in free cash in the next 5 years. Tamarack's 50%. The peer group's closer to 25%. Wow. So anyone who buys these companies is a better company the next day, right? Headwater, it's just like you mentioned, like, are they in a good position or not? They're sitting on cash. They have a wicked play. Like, this all slowly takes care of itself over time. And if you don't re-rate the businesses, they won't be around. Well, we'll see how this all plays out. I'm not going to know exactly how it will, but any companies that buy these companies are going to be set up really, really well.
Okay. That's juicy. Your third pick, royalties, Prairie Sky and Topaz. And I think let's talk about why royalties in this part of the cycle, but I'd also love to understand, like, you know, if you are structuring an energy portfolio, how do you think about royalties versus producers and like kind of the weighting that you want to have? And I guess the role that it plays in your portfolio.
Awesome question. Like, really good question and really mature question on portfolio setup. And like I described, I think on this, we're getting to the point in the cycle where you want more mid-cap exposure. And so we have some of that. We have CES, we have Headwater, we have Tamarack. But let's not just run into all these mid-caps and all of a sudden there's a bigger check back and you lack liquidity or what that looks like. When you look at these royalty companies of Topaz and Prairie Sky, their free cash flow yields are the same as the producers. This makes absolutely no sense. These companies are really good businesses. Again, just like exchanges, royalties are compounding businesses that if you just own these businesses over a decade, they just compound for you, whether that's dividends or share buybacks or just taking that free cash to go buy more of a play or whatever that is. And so we don't think the royalties are priced right. We think, again, if the commodities just stay here, they can go up significantly, but they do play a really good barbell, if you will, within a portfolio. We've been taking the weightings of those things up as our Baytexes are up 30% in the last 30 days. Are you sure you don't trim a little of that to buy some royalties that haven't moved? And they provide stability. It's not just about the upside in our funds. It's about protecting the downside and managing that. You know what? We've had a good move here. Let's move more chips over here. But the royalty weights have been going up in our funds because at the end of the day, the businesses are mispriced. To use a little comparison, Franco-Nevada, Wheaton Precious Metals. Well, these are royalty businesses in the metals gold space. Great companies, wicked companies. But they trade at 25 times plus $3,500, $4,000 an ounce. You're trading these oil companies at 13 to 15, 16 times cash flow, $60 oil. That's where you look at these businesses and go, I think when Prairie Sky, as you recall, Prairie Sky IPO'd in 2014, it was hot. It was the end of the cycle. They brought it out at 25 times. It went to 30 times cash flow because it was such a good business. But today at 16 times, it's expensive? No. It's going at 20 some, right? And so that's where these things are really good bellwether core holdings for us in our funds. And we think over the cycle, they're going to do really, really well.
Let's end it with Tourmaline. I like to joke, whether it's CNQ or Tourmaline, you don't get fired for picking one of those two stocks. And we had a great interview with Mike Rose because the company's at a bit of a significant point, right? You mentioned a lot of companies are not doing capital spending. Tourmaline is. It means that you might see less in the way of special dividends as they look to build up their base dividend. And so investors, I guess they have questions about that and the natural gas outlook. So with that context, why Tourmaline?
Let's start 50,000 feet. The natural gas market is growing at 2x the rate of electricity, and it's growing at 3x GDP. 50,000 foot view. We're going to need more gas, right? And so you can feel that, you can see that, but when I go to all the conferences still, everyone's like, we're going to need more gas, but they don't want any of the companies to grow. And those two things don't match, right? And so as again, we take ourselves back to 2014, what was happening? No dividends, no buybacks, no shareholder returns, grow, spend, rah, guns are out. Well, what have we been in? It's been like, give me all the money back, don't grow, shareholder returns, that's all I want, hand me back all the money. That was wrong. This is wrong. They're both wrong. And that doesn't mean that you go to those extremes, but there could be a balance within there. And you just got to remember, these LNG facilities aren't just 10-year facilities. Like there are 50+ year facilities, all these LNG, US Gulf Coast, Canada. You're going to need gas for a long time. And when you look at that, and you see the Total Energies coming back quietly, the Saudi Arabia is coming back, like this is all happening. And what has Tourmaline done the last 2-3 years? Mow down resource in Northeast BC. Mowed it down. Bought Saguaro, bought Todd, bought Strathcona's piece, bought the other part of Saguaro. You look at a land map now and you're just like, well, they dominate Northeast BC. Mike Rose is smart, you guys. Like you can treat him like he's dumb, but he's the smartest guy in the city. And so when you look at what he's built for where the puck's going, and specifically on gas, and then the data center stuff all coming in behind, like he has built up resource and he has 75 years of resource. And everyone still goes, what's his free cash flow yield? Right? And I'm telling you, you're going to come in the next 12, 18, 24 months, whatever it is. And some of these big boys are going to need a lot of gas. And he will supply to them at the right price for shareholders. And so however that plays out, we don't really know. But the brain from investors will flip as soon as that happens to, well, these guys with lots of resource should be valued higher. And that's where the puck's going. That's how it will play out over time. And he's just caught up in doing something the market doesn't want necessarily on the growth side. But it's actually bolstering the free cash flow profile within Tourmaline. And so we think for the long-term shareholders, we think the pension fund should be all over stuff like this. Like park capital, get long, ride this out on a multi-year thematic, and wake up rich. That's the playbook. And we think he's doing a good job.
Wake up rich. I think I want to steal that as a tagline for the podcast. David, it's been an absolute pleasure. And I feel like we're clocking in and over an hour. And I should just let our viewers and our listeners know you've done that all standing. And you still have a full day, a full job to do. So I appreciate you standing up for us for this last hour. So insightful. Thanks so much for joining me.